get started. Good afternoon, everyone. My name is Beth Lynch. I'm a financial advisor here at Fort Pitt Capital Group. And today I have with me a guest, Pam Swarmer from Swarmer CPA Services. Pam will be joining us to talk about tax saving tips and strategies today. For those of you who are not clients of Fort Pitt Capital, some of you may have attended other webinars, but for those that don't know anything about Fort Pitt, we are a registered investment advisory firm. We do all of our investments in-house. We are a fiduciary. Many individuals and families invest with us, and we do financial planning. We really enjoy doing these webinars. We've been doing webinars for our clients and our community since the pandemic in 2020. It was a great way to stay in touch with our clients and give them the information that they needed. We wanted to be a resource, and it wasn't just for our clients, and that's why we offer these webinars to any individuals. You may see the ads on Facebook, on LinkedIn, and we want to make sure that they're free. We want to be able to help all individuals tackle life questions to put them on a better path. A little bit about myself. I have been here at Fort Pitt Capital Group for 5 years. I am one of the financial advisors, and I'm a CFP, which is a certified financial planner. I like to say that I'm fiduciary squared. As a financial planner, as a certified financial planner, I have a fiduciary responsibility to do what's in the best interest of my clients, along with Fort Pitt being a fiduciary because we are a registered investment advisory firm. I've been working with clients for almost 30 years. Hard to believe. As I count those years up, I have really enjoyed what I do. I got into doing financial planning all because my dad was a small business owner and we didn't talk about money, and we really weren't able to go on a lot of vacations. There wasn't much savings. And so as I grew up and started learning and going to college, I realized there was this whole world out there of financial planning, and I was lucky enough to start with a firm that it was so important for them to talk about financial planning and put plans in place, not just investments or life insurance, but actually full plans. And so I've been doing that since 1994, and I absolutely love it. Outside of work, I love to give back. I try to be as much as I can involved in the community. And I also love to play tennis and golf. Now I'm going to let Pam talk about herself. Besides me, Pam is probably the next, or I'm probably even more excited than I am to be here today to talk about taxes. We're kind of those crazy people that talk about taxes and get excited. So Pam, why don't you tell us a little bit about yourself?
Thank you, Beth, for the introduction. My name is Pamela Swarmer. I am a CPA. I have been working in this field for over 20 years. And as Beth says, I am very weird because I love taxes. I was just telling her that in January, when we get our new tax book to get ready for tax season, it's like Christmas for me. So yes, I do enjoy taxes, and I'm looking forward to going over some things with you today and a little bit of high-level tax tips. And today I'm going to talk about the new Secure Act 2.0, which just came out at the end of December. We are a small firm north of Pittsburgh, and we work with individuals with tax planning, tax consultation, tax preparation, and closely held small businesses and their owners. And I say that we don't prepare taxes, we prepare for taxes. So thank you very much for having me.
Absolutely. We're glad you were able to join us and give us some insight into 2.0 since it did just pass. A lot of tax planning is done at year end, and I really wish I could see a raise of hands of those of you that do wait till year end. And it's never too early to really think about tax planning. So as we move on, I'm going to give you an idea of how you can interact with us. We are going to save a lot of the questions for the end, just so that we can get through the many slides and tax tips that we do have for you. So how you can interact is on a device. You will just tap your screen to ask a question down in the right-hand corner. You can also get the handouts down there that we have. If you're on a computer, on the right side, you will see in the middle, there are the handouts and a place for you to ask questions. So if you need to ask a question, feel free to throw it in there. I will be checking those every once in a while. And if it pertains to something we're talking about and I grab it, we will definitely answer it. Otherwise, we'll definitely review those at the end. If we do not get to your question, please feel free to still put questions in there, because you can either reach out to us or we can reach out to you to help answer some of the questions that are asked after the webinar. Okay, so what would it be like if in the fall of this year, you weren't scrambling around to do tax planning? I don't know about you, but it would be pretty awesome. I can tell you that in November and December, most of the meetings that I had with clients were all about tax planning. And those are the things that we're going to go over today. And here's our agenda. So Pam's going to start us off with giving us an update on the Secure Act 2.0 that literally just got passed. That is thousands of pages. Would you say 4,000 pages?
It's like 4,100 pages.
So it's extensive, lots of little things in there. And it's not just for this year, but it is for some future years. We're going to talk about some tips on non-retirement accounts, retirement accounts, 529 plans, and how we can plan for Medicare planning for those increased premiums. So without further ado, Pam, why don't you get us started on Secure Act 2.0?
Okay, thank you, Beth. Here we go. Like Beth said, this was a 4,100-page bill, and there are numerous tax changes that are sprinkled within that bill. And the tax changes are going to come effective over the next 10 years. So today we're just going to focus on those different tax changes that are going to be effective this year and in the next couple of years, and what is relative to our presentation today. So some of the changes that are going to be happening either now or in the near future, we're going to go through the highlights. The first one that you can see on this slide, and this is probably the one that's been talked about the most, they are increasing the age for the required minimum distributions for retirement accounts. So back in 2019, we had the Secure Act 1.0, and that was where they raised the RMD age to 72. Effective January 1st of this year, it is now 73. So you can see here that there's a little chart. It tells you like when you were born, that is when, as of right now, you should be taking your RMDs. So in the future, written in this law, they are expecting that in 2033, they are going to be changing it so that you have to be 75 in order to take your required minimum distributions. In addition, with the required minimum distributions, if you do not take the RMD when you're supposed to, the IRS imposes a 50% tax on the portion that you did not take out. So for example, if you were supposed to take 10,000 and you only took 5, there's a 50% penalty, which means a $2,500 penalty, a tax penalty for not taking out those required minimum distributions. They are changing it effective for 2023. They're dropping it from 50% to 25% because they know that there have been all of these new changes, and it's very confusing. A lot of people didn't understand. So what they're doing is they're trying to help as we make all these changes. And if you are able to contribute to, or I'm sorry, if you're able to rectify the situation so that you are taking the required minimum distributions in a timely fashion, even though you didn't do it when you were supposed to, then they're reducing that down to 10%. Some of the other changes, they changed the catch-up IRA contribution. It is usually $1,000. It's been $1,000. It usually does not change year to year. However, with the new law, they are in 2024 going to index that for inflation, which means it'll start to increase similar to other contribution limitations. They also are changing in 2025. This is another big point that I think is a really great move. In 2025, they're going to increase the catch-up contributions for 401ks for anybody aged 60 to 63. So right now, if you were going to contribute to your 401k and you are 50, for 2023, you can contribute $22,500 as your regular contribution, and then you can contribute $7,500 as a catch-up contribution, as long as you're 50 and older. What they've changed starting in 2025, if you are 60, 61, 62, and or 63, you can actually contribute the greater of $10,000 or $150,000 of the standard catch-up contribution for 2024. So for 2023, our catch-up contribution is $7,500. We're expecting in 2024, it would probably be about $8,000, $8,500. So in 2025, you can either contribute $10,000 or 150% of what we're expecting to be $8,000, which is actually $12,000. So this means that if you're getting ready to retire, this is going to give you a chance over the 4 years, 60, 61, 62, and 63, to contribute your regular amount of $22,500 plus a really big catch-up contribution. So they're really trying to find ways for people ready for retirement to really beef up those retirement accounts. Okay, Beth, slide. All right, thank you. Some of the other points, starting in 2024, if you're an employee who's earning over $145,000 in 2023, your catch-up contributions have to go into an after-tax Roth account. They also added a provision in here for withdrawals for emergency expenses without a penalty. Right now, if you take any, funds out of your retirement, there could be a penalty. So they're allowing $1,000 to come out in a 3-year period or after repayment. So if you take $1,000 out and then you turn around and pay it back within like 6 months, then you can take out another $1,000. But if you take $1,000 out and you don't repay it, then you're not able to take another $1,000 until after 3 years has passed. And this will be effective in 2024. They've changed the qualified charitable distribution which is $100,000, and that will actually be indexed for inflation starting in 2024. The next point, which is the 529 plan, this is another really big point. There's been a lot of talk about this, and I think this is a really great tax move. So they are changing the 529 plan rules. And right now, but I should say prior to 2023, before this goes into effect, which is in 2024, if you can have money in a 529 plan and you don't use those funds for education expenses and you take that money out, you have to pay tax on the earnings and you may have to pay a penalty. And because of this, this is a reason why people don't want to contribute to a 529 plan, because they're afraid, well, I'm going to put money into this 529 plan. My child might not go to college. My grandchild might not go to college, or we might not use it all. And then that money is just sitting in that 529 plan and it can't be taken out without paying tax. So what they're doing is they're saying, okay, we're going to give you a way to get that money out of the 529 plan, tax and penalty free, and we're going to allow you to put that over into a Roth IRA. It must be in the beneficiary's name and the taxpayer's name. It must be open for more than 15 years, and it will be a $35,000 lifetime limitation as long as the account is in their name. So we're still going to have to be careful with this, though, because you can't just take $35,000 in 1 year and roll it into that Roth IRA. You still will have to pay attention to what the Roth contribution limits are, which is why they're doing $35,000 over a lifetime. So if the Roth contribution limit that year is $6,000, then in that year you can only transfer $6,000 from your 529 plan into the Roth without it being a tax penalty. Okay. Some other points: employers can match student loan payments in 2024. This is another really cool thing that they put in here. We have a lot of, graduates coming out with really big student loans. They're making student loan payments and they're starting in the workforce. And because they are making these big student loan payments, they can't afford to contribute to a retirement account. Typically, employers match your contributions to a retirement account. And in the past, if you didn't actually contribute, then your employer cannot match. So if you're a student coming out into the workforce and you can't afford to put money into a retirement account, what they're allowing for is if you're an employee making payments to the student loan, then the employer can say, okay, if they made $5,000 in student loan payments and I match 3%, now the employer can take 3% of that $5,000 and put it into the retirement account on behalf of that employee. So that's a good thing. They're really trying to help out graduates coming out with these big student loans. The next point: employers can now contribute to matches to a Roth. That's also going to start in 2024. And also in 2024, they're eliminating the required Roth distributions for Roth 401ks. Okay, next. All right, so I'm just going to briefly touch on some of the future changes, some of the highlights that are, more relevant to today's presentation. In 2025, they're going to make it so that employers have to sign up new employees automatically with their 401k or their 403b plans. And they're also going to have automatic annual increases. So what they're finding is a lot of people are starting with an employer and they know that the 401k is there, and either they don't know how the process works or they don't know how to get it set up, and a lot of people aren't taking advantage of this additional benefit. So what they're going to have is the employer is now going to be responsible for automatically enrolling the employee in the plan, and it's going to be up to the employee to come back to the employer and say, no, I don't want to be in the plan. And then they're also going to do annual increases in percentages. So every year it's going to be a 0.5%, 1%. This is still to be determined. They're also in 2025 changing some things to improve coverage for part-time employees. In 2026, they're going to permit an early withdrawal from a retirement plan up to $2,500 per year to pay for long-term care premiums without a penalty. And again, this is going to be in 2026, so we'll kind of keep an eye on this and see, if there's any changes to this, and I'm sure we'll get more clarification. In 2027, this is another change. They are coming out with what's called a savers match. And a savers match is basically what the old savers credit is changing over to a match. So right now, a savers credit, if you are making under a certain threshold and you still contribute to a retirement account, you actually qualify for a credit, which will reduce your tax burden as a reward for still contributing to a retirement account, even though you're under a certain income threshold. So in 2027, they're changing it over to a match, which means the IRS will, instead of giving you a credit on your tax return, the IRS is actually going to deposit into your retirement account a match, and the amounts and percentages and everything will be determined and it'll be subject to income limitations. So again, this is something in the future. We're going to need to kind of watch this and see, you know, how they come up with the different restrictions on this. In 2028, there's going to be a deferral of tax for certain sales of employer stock to employee stock ownership plans. Again, in the future, a lot of things are probably going to change between now and then. And there's a lot of other little tax changes related to small business retirement plans and some other tax law changes that we'll have to watch as we go into the future. I've added the tax brackets and the retirement limits so that you have a reference of what we're looking for. Overall, the tax brackets, which is your income for each tax bracket, has actually been increased for 2023. So that means you can make more money and pay less tax. The long-term capital gains is pretty much the same, but this is just going to give you, you know, what the different thresholds are. If you can go to the next slide. And then for the next slide, we have the different contribution amounts from 2022 to 2023. This has probably been one of the biggest increases. So you can see that they're really trying to, you know, get taxpayers to put money into deferred and tax-free accounts. So they're increasing the limits, they're increasing the income restrictions, and they're really, that's what the theme is here, that they're really trying to encourage people to, hey, put money away, put it into your retirement accounts and save for the future.
Absolutely. Self-fund, no one to rely on, right? So we're going to go into non-retirement accounts. And this is something that we really adhere to here at Fort Pitt Capital. It's a tax loss harvesting. This is one way to reduce taxes and something that should be looked at on a very regular basis. And it's fairly simple to do, except in years where there's lots of gains. And I'm going to go back to 2021, which was a phenomenal year for the market. And I can tell you that in those years, it was really hard to find losses to offset any realized gains that we took in portfolios. So our clients did have a little bit of a tax hit in 2021 because of the market and the growth of those assets. And as we were selling, because things go up, you want to sell low or sell high, buy low, sell high, the good old saying, right? And with that comes taxes. So if we sell something, we realize that gain, you're going to pay taxes on it based off of that schedule that Pam just showed in the previous slide. So what happens when we have a year like 2022, where we had some gains that, I'll use our portfolios, for example, we had some gains in January, we were able to take those gains and realize them. So let's say a client took, you know, $20,000 in gains through the rest of the year. If we sold anything and realized a loss, we can offset those gains with those losses. I won't dive into long-term or short-term, but and how they offset. But what you need to know is if you have more losses than gains in a particular year, you can use what's called a carryover loss, and that goes into future years. And that's because you can only take a deduction for above your gains of $3,000 for losses. So on your 1040, you'll see a capital gains. The most that you can take in losses is $3,000 per year. Not sure why they haven't increased that number, but there's still a lot of people that have large carryover losses, believe it or not, from 2008, 2009, that they haven't used, even though we have had some really great years. So something to think about is if you have an opportunity, again, I'll use the $20,000 in gains, and we were able to take 40,000, let's say, in losses, we can take $17,000 for 2023 and carry that over. So the first $23,000 of realized gains would not be taxed if you think of it that way. So we do that a lot. We try to set some capital gains budgets where we need to make sure that we're cognizant. of each individual's tax situation so that we can kind of control the taxes. But sometimes there are years where we can't. And that just means we're making money, and hopefully clients do understand that, but we do try to be very tax efficient. Pam, do you have any thoughts on any other tax loss harvesting?
No, I think you did a good job explaining it. And I did have a lot of clients when we prepared 2021 tax returns that had a lot of capital gains. And same thing, I explained to them, you know, it's a good thing. I always say I'd rather make money and have to pay tax on it than not make any money at all.
Exactly, exactly. So the other way we can give to charities and take deductions is through gifting. And most of us know that you can gift, you can write the check, send it off to the charity, no problem, and you can enjoy a tax deduction, assuming that you make it, that you're able to itemize it because of the standard deduction being increased. And I'm gonna let Pam go into that more in a minute. But if you give cash, you can take a tax deduction if you gift that to a charity, a qualified charity, I should say. The other way to gift is through appreciated stock. So I said earlier that sometimes we have these stocks and we might have a large capital gain in them. And so, but so we don't want to realize that gain. So I've had clients say, Beth, I really want to gift, but I really don't have the cash on hand. Can I gift securities? So we'll want to look at positions in which have a large gain to them. And there's benefits, not only the charities, but you as the taxpayer. You can avoid capital gains tax on the appreciation by gifting those shares, and you can receive a tax deduction. And the nice side is the charity gets those shares, and because they're a nonprofit and qualify, they will not pay any tax on the sale of those shares and can sell them right away and use that cash for the organization. So I'm going to let Pam talk a little bit more about what that deduction looks like I said, with the standard deduction versus itemized, and then raising that standard deduction. This has really weeded out quite a few of itemized gifting, correct, Pam?
Yes. So there was a big tax change back, we call it the Trump tax. And it was where they changed the standard deduction and increased that standard deduction significantly. So for 2023, the married filing joint standard deduction is $27,700. And this means that it doesn't matter if you have no itemizations or not, you still are going to get $27,700 if you're a married filing joint taxpayers. So the way the standard deduction works, the itemized deductions, if you have real estate and state and income tax over 10,000 or under 10,000, it's capped at 10, and mortgage interest and charitable deductions, and in total, they are above the $27,700 married filing joint. If you're single, it's $13,850. If you have those itemized deductions above those thresholds, then you can itemize. If you don't, then you take the standard deduction. So when you're doing tax planning around charitable gifting, you want to make sure that it's not, because I've had issues with clients where like, well, I gave a $500 charitable contribution. I get that as a deduction, right? Well, no, because your standard deduction ends up being higher than all of those deductions, including that $500 charitable deduction. So when we talk about this from a tax planning standpoint, we're talking about we want to make sure that you're gifting much higher than of like a $500 contribution. It's got to be with everything else over your $27,700 standard deduction. So in the situation of the securities, and Beth, her point was spot on. If you have some securities that you purchased back, we'll say, for example, like a PNC, because they're local, and you bought them back in 2000, and I think back then it was like trading for $44 a share, and now you have still hold these shares, and now they're trading for $160 a share. So there's a huge unrealized gain there. And if you want to give money to a charity and you want to, cash in that stock and take that money and give it to the charity, now what happens is you're responsible for paying the capital gains tax on that appreciation. And that's going to be based on your income. So it could be a 15% or 20%. And then you turn around and you would if you can itemize, then you would deduct that on your tax return. However, what we could do is just take those securities and transfer them over to the charity in whole and not actually cash them out, so that now you're not actually paying the tax on that.
Perfect, perfect. And a lot of times, Pam, we tell our clients that in order to take advantage of the itemized, sometimes we'll do what's called bundling, yes, gifting. So maybe in 1 year you gift, $30,000 along with all of those other deductions for 1 year, so you can itemize. And then the following year you'll just do your standard deduction. And so if you're normally doing about $15,000 a year, it's called bundling, or kind of lumping them together into one tax year to take advantage of that tax deduction for itemized, and then the following year do a standard deduction. I did have a question, and this is going to be for you, Pam, because I don't know much about this. Is the raising of the tax deduction, I'm going to assume this is for the real estate, from 10,000 to 80,000 dead? Have you heard anything about them raising the tax deduction from 10,000?
We're hopeful that it's going to happen, but they haven't done it yet.
So hopefully it does go through. Perfect. Okay, retirement accounts. This is one that I love talking about. This is a great way to gift and to decrease your taxes either now or in the future. There are so many opportunities when you're looking at tax deferred accounts, retirement accounts across the board. I do have to say that, I'm gonna reiterate, required minimum distributions increased age 73 this year. This is the first year, and a lot of my clients don't know this, and you only know if you have what I call a milestone birthday. Every January, first day of the year, I usually send a milestone birthday email saying, hey, you've hit a milestone, you get to take a required minimum distribution this year. This is the first time in my life that there are no new recipients of a required minimum distribution. If you were 72 last year, you had to take it. If you're 72 this year, you're not taking one, or you're not required to take one. This is the very first year where there's actually not any new participants or individuals that have to take a required minimum distribution. So that was one less email I had to send everyone. But usually I send that out saying, hey, you get to start required minimum distributions this year. But by doing that, it's giving us some extra time to do a few other things. So the first thing that we can all do right now to save on taxes is maxing out your contributions to your 401ks or IRAs, if you can do those. By maxing your 401k out reduces your take home. So it reduces your taxable income that you're reporting on your 1040, which is a wonderful way to save taxes and put money away for yourself. A forced savings, bi-weekly, monthly, however you're getting paid, along with a lot of companies matching that. So for those who aren't maxing out, I would say please don't leave money on the table. At least put in what your company match is so that you're getting the benefit of those $3. Then for those that are of us that are over 50, we have what's called a catch-up contribution. Make sure you're taking advantage of that, not only in your 401ks, but you can also do in your IRAs if you're eligible to contribute to an IRA. They also increased, and correct me if I'm wrong, Pam, because I did not mark it down, but I believe the employee and employer contribution to 401ks and 403bs is 66,000 this year, was 61. So if you think about it, even for pre-tax, if you have an after-tax contribution that you can put in after-tax dollars, this is a great way to save also. You may not be getting the tax benefit in your current year, but in future years, it will be very beneficial. You can roll that to a Roth, once you retire, or if you're one of the lucky individuals that has a plan where you're allowed to do after-tax contributions and in-service, what we call mega Roth conversions, where you are able to take those after-tax contributions and roll them or convert them into a Roth in the same year. It is a tax-free way to get $30-some thousand, $40,000, depending on where your limits are and what your employer matches, over into a Roth without worrying about income limits. So it's kind of that backdoor for big 401ks and 403bs. Roth conversions, if we can do Roth conversions up until the time where you have to do your required minimum distributions, this is wonderful. So these are the things that we want to plan for and we want to look at on a very regular basis. There may be a great opportunity to convert those tax deferred assets into tax free. And before I go on to Roth conversions, is there anything you want to add, Pam, about maxing out 401ks or IRAs?
No, I agree with you that these are some really great ways to put some money away to, defer tax or even put them in accounts that are considered never taxed. And, I think we have, already kind of talked about all these points. So go ahead, we'll move on to the next.
Perfect. So Roth conversions, a lot of individuals ask, when's a good time to do a Roth conversion? Can I do a Roth conversion after 73? And where do I pay the taxes from? So this slide is going to give you just a little bit of an idea of when to do a Roth conversion. Who does it make the most sense for? And the flow chart to the right kind of gives you an idea. So when's a good time to do a Roth conversion? I can tell you that last year, with the market being down in 2022, we did quite a few Roth conversions. Why? The market's down, Beth. Why would I do a Roth conversion? Wow, how awesome is it to be able to take an asset that depreciated in value, you take it out of a tax deferred, at some point you're going to pay taxes on it, you put it into a tax-free bucket that when the markets come back, and they will come back, it will continue to grow completely tax-free. No required minimum distributions out of that bucket of money at age 73, and you get tax-free growth. So to be able to do a Roth conversion in a down year is a great time to do that. So we still have time. There's nothing wrong with doing it here at the beginning of the year. Markets are still a little choppy. You haven't lost out on being able to do a Roth conversion. I was doing Roth conversions up until December 28th. Not that I prefer that, that's for sure. But when should you do that Roth conversion? Well, you want to think about a few different things. Do you think that you're going to be in the same or a higher tax bracket when you retire? If so, you might want to do a Roth conversion. What's your time horizon if you did the conversion? Are you going to start taking the dollars out of that Roth IRA because you need it for cash flow? If so, maybe not convert. If not, and you plan on leaving that, and maybe that's your legacy, then okay, that's another reason why you might want to do a Roth conversion. And then the next question is, where are you going to pay the taxes from? We really prefer that you're able to take that Roth conversion from the IRA, put the whole amount into the Roth, and pay the taxes from after-tax dollars. Keep those dollars earning, keep them in that tax-free bucket, growing for you, and use them after-tax dollars. We've had situations where the dollars aren't there, but it still may make sense. So make sure you talk to your tax advisor or your financial advisor about what that looks like and if it makes sense for you based on some of the other criteria. The next thing is, can I do a Roth conversion after 73? This is a big one, and this can really get messed up. And I'm going to say age 73, but I'm going to say once you're required to take a minimum distribution. So Roth conversions can be done in years where there is a required minimum distribution. However, huge asterisk, you need to take out your required minimum distribution prior to doing any Roth conversions. If you do not do that, that is a big no-no. There are penalties for that. Make sure that you take out your required minimum, and then you can do anything with Roth conversion. You cannot use your RMD as part of your conversion. That is a big, no-no. And a lot of people think that you're allowed to do, take it, since you're paying taxes on it, that it would count as a required minimum distribution. It does not. Should I pay taxes from my IRA or from after tax? I did hit on that. We do prefer that you use some after tax dollars for that. But again, there might be situations in which it would make sense. Okay, anything else on the Roth, Pam?
No, we do a lot of tax planning around, should we convert to a Roth, and the same things that you're talking about. Do we have the cash to pay the tax? What's the tax going to be? And same thing with, doing some tax planning around the other type of retirement accounts.
Sure. So one of the questions was, there's a lot of chatter about a flat tax and how would that affect Roth conversions? So that would be kind of interesting. I think we would have to kind of go back. I think it would still depend. You still have a decent, your required minimum distribution. If that 401k or IRA was so large, I would say we have a lot of individuals that are qualified rich, meaning they've done a great job of saving. And at some point you are going to have to take that out. And even with a flat tax, that number can still be very large. Mm-hmm. And if you want to be able to leave those dollars to your heirs, it makes a lot of sense. The other reason, and I'm going to touch on it actually next, but I'll just mention it here because of the question, is when you leave those assets at IRA as an inherited IRA to a non-spouse, remember there's a 10-year rule. So those assets are going to have to be distributed within 10 years after death. So your beneficiary could face a point where they have to take out some large distributions, and even with a flat tax, there might still be a really good opportunity to do the Roth, because even though they have to take the Roth out over 10 years, it's completely tax-free. So it still may make a lot of sense even if there was a flat tax. And the question goes, we've seen taxes change. Even if they did a flat tax, there's nothing guaranteed to say that they wouldn't overrule that and put the brackets back in there. Any thoughts? You think I'm okay with that?
Yeah, I agree.
Okay. Can you do a mega Roth conversion if you have other IRA accounts and pay no tax? Yes. You can still do it. The mega Roth it's using after tax dollars to do the Roth conversion, or the mega Roth conversion. It's very specialized. So if you do have after tax dollars, you do need the plan summary to make sure that you're allowed to do that. If that is something that you're thinking about, please feel free to give myself a call. We can go through it. We can make sure that your plan allows for that to happen. This is a little different than when you have an IRA and you're doing a conversion to the Roth, where you have to worry about the taxes and the tax ramifications of other IRAs. So it is a little different when it's a mega Roth inside the 401ks. So please feel free to reach out to me if you want some additional information that's specific to yourself. Okay, the next is inherited. I talked about that a little bit. The Secure Act did put into place anyone who passes away 2020 and later. The stretch is gone. You can no longer stretch out your required minimum distributions from an inherited IRA. So when someone inherits that, other than a spouse, there's a 10-year rule. There's some exceptions, minors, some disability, terminal ill, those types of things that are asterisked, if you will. But this is huge, because if you are leaving assets to an heir, think about the tax ramifications. And so this is, again, where Roths can really make a difference, in using Roth conversions to get those assets into inherited Roth IRAs. Again, you still have to take it out, but talk about tax-free. If you're leaving your IRA, let's say, to your children or grandchildren, depending on their tax bracket, and then they have to take this out over 10 years, it could really impact what their tax situation looks like and actually put them in a very, very high tax bracket. And as we get older and we're living longer, sometimes those assets are being inherited by individuals who are 65. And guess what? We've got Medicare and we've got IRMA, which we'll talk about once we get down to the Medicare. Any other thoughts on inherited IRAs?
No, I think you touched on all of the points that I would have gone over.
Great. So why don't you talk a little about health savings accounts and how I've done a lot of talking here. So I'm going to throw the health savings accounts and what the benefit is of using them.
Okay, so a health savings account is an account where you can, depending on how you use it, it could actually be a forever tax-free account. So you're going to put money into the health savings account, and if you take the money back out and you use it for certain medical purposes, then it is a tax-free account. And so, the same thing with like a 529 plan or any other kind of plans. If you are leaving it in there, for example, you're putting money into an HSA and you really have no medical expenses, and you really don't need it, and the earnings grow and grow and grow, that will be completely tax-free when you take that back out. And the good thing is you can use it later in life for like long-term care premiums and things like that. And then that is, again, tax-free.
Absolutely.
And they did raise the contribution limits. There are contribution limits every year as like other plans. And this year it's $38.50 for individuals and $77.50 for a family.
Perfect. And then the next is qualified charitable distributions. This is one way to really save some tax dollars. There are some caveats to the QCDs that we call them. But what a QCD is, or a qualified charitable distribution is, it's a direct transfer of funds from your IRA to a charity. And this does count towards your required minimum distributions. You pay no taxes on those dollars. The big thing is you must be 70 and a half or older. I always tell my clients, let's calculate 70 and a half in one day, just in case. And the max amount that you can contribute to the QCD is $100,000 per year per person. So you have to make sure that your IRA is large enough to be able to do that $100,000 per person. There is no shared. So, if one spouse has a very large IRA, you cannot do $100,000 for each spouse out of one IRA. It has to be out of different owners. So that's a big one. The one caveat to this, I will say, and the one thing that actually does drive a lot of CPAs crazy, is making sure you communicate with your CPA that you've done a qualified charitable distribution. And why do I say that? When you receive your 1099 for your IRA, it'll show the distribution, but nowhere on there does it say that it was made to a qualified charity. So if your accountant is not aware, it looks as though you took that $100,000 out and it's taxable. Even if no taxes were withheld on that form, please make sure you let your accountant know who you made those donations to and how much were qualified so that it can be properly marked on your 1040.
Absolutely, yes. And the other thing I will say too, that the $100,000 is going to be indexed for inflation starting next year.
Yes, finally, right?
Yes.
Okay, 529 plans. I know we're getting closer to, I can't believe it's almost 10 till. So we can go through this kind of quickly, but I want to hit on a few big points. Is the 529 plans, there's no tax deduction for federal. However, there are many states in which you can get a state tax deduction. There are a few states that do not allow one. Some states you actually have to, if you're in that state, you have to contribute to their plan. Pennsylvania, you're kind of lucky. You can actually contribute to any 529 plan and get a deduction. Pam, you want to talk a little bit about the front loading and some of the benefits of loading a 529 plan?
Sure. So front loading a 529 plan just means that you can actually contribute the maximum gift limitation of that year times 5 years up front. So for this year, it is $17,000, which is the gift limitation. And you can actually contribute 5 years at once into a 529 plan, which would mean you could actually put in $85,000 into a 529 plan for either a child or a grandchild. And as long as you do not gift any further dollars to that person over the next 5 years. So it's a really good way to get a good chunk of money into a 529 plan. And especially now with the new changes with the Secure Act, because we know that now if that money isn't used, instead of it just sitting in that 529 plan and growing and then coming out and causing a tax event, we know that $35,000 eventually after 15 years can get moved over into a Roth. So it's a really good way to get a chunk of money into an education account. If you pull the money out for education purposes, then there's no tax consequence. Some of the other things with 529 plans that we have to really do a little bit of planning and keep an eye on are when you're taking money out of 529s, just watching how it affects some of the other things, some of your education credits and things like that. So you just want to make sure you talk to your tax professional, and you want to make sure that if you are putting distribution or contributing to a 529 plan, just be careful if you're putting it into your child's name, or if if you're a grandparent and you're putting it into the parent's name. Just watch, with those different rules.
Absolutely. And there are some new rules starting in 2023 for grandparents who own 529 plans. And it's becoming a little bit more advantageous. Prior to this rule, any qualified distributions from a grandparent's 529 plan counted as untaxed income to the beneficiary. So that student's financial aid could have been impacted because it came from a grandparent's owned 529 plan. Starting for the school year 2024-2025, this is where it's going to be beneficial, because the grandparents are now, basically those plans are completely invisible for the FAFSA calculation for both assets and for income. So even more valuable. So if you're thinking about starting one for a grandchild and they're not in school yet, this is a great opportunity to take advantage of these new rules that are starting with the new FAFSA forms now for the next year. And remember that FAFSA forms look back 2 years. So it's the prior year's income. So any gifts that grandparents gave would impact eligibility. And so starting this year, they're going to be invisible. That's not even going to be a question on the new FAFSA as far as gifts to grandchildren. So huge benefit. There's a lot going on with that. For the sake of time, I will make sure that, we kind of move on. There was a question here. Sorry, I was reading that at the same time. Is the 529 plan only for relatives? So you can set up a 529 plan for anyone, quite honestly. What those dollars look like when they come out, if it's not owned by a parent, a grandparent, will be a little different. That untaxed income could show up as to go against the eligibility for financial aid, but you can set one up for pretty much anyone. And as the owner, you can change that beneficiary. So, a lot of times it's not too often I have anyone do it who's not a relative, even if it's a niece or a nephew. It usually is, but I've seen people do it for friends. They don't have children, and one of their best friends, their kids are like their nieces or nephews and want to set that up. So you can set it up. There's just different caveats to it, but you would still get the state deduction for contributing, even if they're not a relative. Okay, Medicare planning. This is something that I try to watch and make sure that we're planning for. This is a big one that a lot of people don't realize the impact until it's too late. And so when do you start Medicare planning? Age 63. And I know there's a lot of people looking at my schedule there. Medicare premiums 2021 modified adjusted gross income, single and joint, and saying, Beth, why is it 2021? And that is because your Medicare premiums are determined based on the tax return or your income, your modified adjusted gross income 2 years prior. So when you're 63, whatever happens when you're 63 will affect when you're 65. So think of it that way. And then for the rest of your life, every year, any income. This is why you need to know where your income is coming from, whether it's pension, Social Security, dividends, capital gains, municipal bond income. Yes, that comes back into the equation. You want to make sure you know what that IRMA is, that income related monthly adjustment amount, because that is what is going to determine your Part B and D adjustments. It's amazing how quickly, once required minimum distributions start at 73, I've got to get that in my head, where this can really jump up to the point where, you know, a individual is paying over $350 a month for their Part B and D because of RMDs, not taking advantage of maybe some QCDs if they're charitably inclined, having capital gains on their other assets. So again, this is where Roth conversions might actually come into play as long as you do them early enough. So planning this out and knowing what to do from the time as early as possible, really, to plan for Medicare premiums. There are waivers during life events. So a lot of times I'll tell clients that when they turn 65, we've done some conversions and they've stopped working and they go on Medicare. Sometimes we can apply for a waiver due to retirement and the income coming down. And so sometimes we can get those premiums reduced based on that. But that's something that you're going to want to just talk to an advisor with. A lot of people don't know that that waiver exists. I can't remember the form number, but it is available. And if you work with someone who does Medicare, they'll also tell you and help you understand what that form is that you can file. But the big thing is really keeping an eye on capital gains. And I've talked about that. We talked about Roth conversions. We've had people do Roth conversions and just take the hit, you know, do a big one, pay the tax, get hit with their Medicare 2 years later, but then they're done. So there's different ways of doing it depending on your situation. And that's what we're here to do, is help you determine if that what makes the most sense for your situation. Pam, any thoughts on Medicare?
You pretty much said it all. We just have to be very careful with, you know, doing some tax planning around it and making sure that we know what the income changes are going to do to the Medicare premiums.
Absolutely, absolutely. And that's going to do it for us today. We have a few minutes left. I'm going to check out to see if we have some questions in here. Here's our upcoming webinars that are coming up January 24th and February 8th. If you have some questions for Pam, if you don't have an accountant, need an accountant, some questions, there's Pam's contact information. Again, we want to thank you all for attending. I hope you found it very valuable, and we're going to answer a few questions. So let's see what we have up here. Let's see. Something on life expectancy tables for calculating the RMDs now based on 2020 census. I don't believe it's the 2020 census. They actually changed the uniform life table based on some actuary tables. It was actually supposed to go into effect in 2020, but with everything that was going on with the pandemic, they never changed them. They actually just changed those tables last year for the first time that they get, they change with individuals living longer. So it's not actually off the 2020 census, but they did change it. So if you look at the uniform table back in 2019 compared to this year, you'll see an increase in life expectancy. What is the deal with Roth IRA conversions with still contributing to a SARSEP and about to turn 73? What are the restrictions and limitations? That's a good one. Pam, do we know, I'm not as familiar with, what would the deal be with Roth IRA conversions? It would still be taxable. and you're still contributing, you can still contribute to the SARSEP. If you're turning 73 though, the SARSEP, you still have to take out your RMD, correct, Pam? Unlike the 401k, if you contribute.
I believe so.
So I believe the only one that you get a waiver on is the 401k and the 403b. I think the SARSEP, you still have to take that out. So if you're going to do that Roth conversion, you know what, I'm going to look that one up and I will figure out who sent that one. And we will find out the restrictions and limitations on that one. That is a great question. I don't want to give the wrong answer. And I'm not afraid to say that I don't know the answer to that one.
That's a complex question.
Yes, we will look that up and get you that information. We talked about the tax deduction raising, IRA contributions required active income. Correct. Yes, you need to have earned income in order to make an IRA contribution. That is correct. So even though I make real estate rental income, I'm not able to contribute to an IRA.
Correct.
Correct, correct. Now, if you have a spouse that has earned income, you can do a spousal contribution.
Yes.
So just remember that there is a spousal contribution as long as the other spouse does have earned income. And I think those are the questions. I know we had quite a few that were asked in the I guess you could say in the registration. So we will make sure, we just want to be cognizant of everyone's time. We're a few minutes over, but the questions that were asked, we will either have your advisor reach out to you with those answers, or feel free to give us a call if you do not have an advisor. And if you're not have an advisor here at Fort Pitt, I will make sure that I follow up with you and get you those answers, and even consult Pam on some of them that I would need a CPA to help me answer. With that said, I want to thank everyone. We look forward to helping you in your financial journey. And if there's any questions, please let us know. And I hope that you have a great rest of your week. Thanks, everyone.
Thank you, everybody.